Thank you so much for the invitation. And yeah, so this is the final question. And I'm going to be talking about job displacement insurance and consumption smoothing. Um, so, oops. All right. So I'm going to start by defining what this is. It's not showing. Okay. All right. So I think now it's working. So yeah, so I'll start by defining what our differences and also taking a step back and sort of talk a little bit about trade-offs in the design of job insurance before I focus on what the talk is mostly about, which is about the insurance value of the policy and around the moving it that we can obtain. And then I will discuss some implications for policy design. So, starting with the definition. So, I'm sure all of you said at some point unemployment insurance, and unemployment insurance is part of a bigger set of policies that we are referring to as job displacement insurance. And basically, these are policies that are government mandated or provided uh, to financially support workers that are displaced from a job. So there is a useful typology that highlights the four main types of policies that are typically debated, you know, debated not with countries. So one is unemployment insurance, which is basically the type of policy where benefits are contingent on being displaced and also on remaining unemployed. So it's contingent and it's. And then there are government mandated severance payment type programs. And I'm emphasizing here government mandated because in many countries there is no severance pay that's mandated by the government, so they it's only by their own service provided by firms as part of a severance package. But in most countries actually, there is government mandated pay that basically is a lump sum transfer to workers by firms as layoff and it's also and then there are like savings-based types of policies. There are severance savings accounts. So those are typically accounts that are liquid, that the government mandates that a portion of the wage is put aside during deployment, and then the accounts become liquid once workers are laid off. So taking off the and then there are the unemployment insurance savings accounts, and these are actually quite popular, quite prominently debated today because it has an interesting sort of feature where it's actually based on savings of the workers, just like the severance savings account. But the difference is that it's also state contingent in the sense that workers have access to portions of those savings as they are unemployed. So, and those payments are contingent on remaining unemployed. But they actually have this feature that any balance in this account is sanctionable. So in a way, it's better for incentives than pure unemployment insurance type of program just because it's the workers' money basically. So any savings that remain, they are pensionable. So these are the main types that are discussed. And if we look across countries, actually, we observe that in sort of higher income, UI has always been the main policy. And so they often coexist with severance pay. And the other types of policies are very, they are not as common. And if you look at like middle income, then actually severance pay type programs are much more common. And unemployment insurance funds like this, and both are increasingly available to workers, but it's really about type of policy. And actually, right now we are writing a handbook chapter on this, and we're this data. So soon there will be a little bit more of analysis on this. Mhm.
Verify the type of thing.
Mhm.
This is all just like fund, that's like mandatory.
Mhm. Yeah. Yeah, that's the idea. Like you basically put some on your side that's upon a shock, and often the savings account, Brazil has one of these. It's not just unemployment that triggers access to this account. Sometimes if there's a natural disaster, there are a few other situations in which you can actually have access to it. So it's a broadly speaking rainy day account, but typically the access is triggered by layoffs. Mhm.
The government health that people will already take it down, like they would provide bundles of the
No room for that. Yeah.
Really tough.
Yeah. And here, just like, if you are all like thinking about your research project, something that I wanted to highlight is that, there's a very vast research surface on unemployment. And there is much less on anything else. Especially when you think about low middle income. And we know that say is a much bigger important concept. So this is something that could be improved potentially. And actually, if you look at the 1978, this is a paper that was very influential, still is very influential to think about unemployment insurance. Actually, it touches both lump sum payments and unemployment insurance type schemes. So I think it's something to consider. And so before I answer the evidence on compulsory smoothing and like talk about what we know about it, I want to take a step back and think about the incentive insurance trade-off just to make sure that we are all on the same page about it. So very quick overview. If you think about the normative reasons why we want government intervention, typically the first thing that comes to mind is the issue of asymmetric information, because risk types are not observable, right? So this could lead to a competitive equilibrium that is inefficient or just failed to exist. And the government incentive is not really that the government can observe types, so they're equally unobserved, the government as it is the private sector, but the government can mandate that people buy insurance, right? So then that way directly addresses the adverse selection problem. Then there's aggregate risk, right? So there's private insurance relies on idiosyncratic shocks and transactional risk sharing, and governments can use that shocks across the duration. So this is something that they might be uniquely positioned to do. And then, of course, we're here in a behavioral economics bootcamp, and there are all sorts of internalities that could potentially justify also government intervention. The main one that could be is that present bias workers is not self-insured enough. And that's where things like for savings accounts can make sense, or some other policy to facilitate people's savings for their own sake. But then, there is clearly room for government intervention to help workers smooth out costs. But how much government should intervene depends on the potential incentive effects. Because any type of insurance, that's social or private insurance, will create incentive effects that increase the cost of providing them. And governments do not really have a clear advantage on addressing moral hazard necessarily. So the full insurance probably will not be, there will be a trade-off between insurance and incentives. Okay, so the usual Bailey formula, the way we think about it, is that the transfer can now like what is the optimal insurance to be provided. So basically trying to balance the insurance value of transferring $1 from the state where workers are collecting benefits from the state of workers that are actually contributing to this to the collectionality that it creates. So basically, any additional cost that arises from transferring $1 to the it's a ratio between the behavioral cost the employment rate, the molecular, still the technical cost is the additional benefits that are draw absent of any behavioral response. And basically, at the optimum, there's always going to be partial insurance because, of the historic externality. So, because people change behavior, you may not want to fully insure them between these two states of the world. And the generosity will increase with the curvature of the function, depending on how we reverts to support as well. And also the size of the consumption gap, right? So, being the difference with absence of the benefits is enormous between, say, the states that are unemployed, you might want to provide more. And also the amount of externality, the amount of moral hazard. And the behavioral systems that can actually affect both sides of this trade-off. We will think about mostly how the affect is more utility of consumption. And it can also affect the formula itself. And here I want to just refer to my colleague, Johannes, I gave a lecture last year here in this bootcamp. I have checked, it's still available online, and it actually goes through it carefully. So if you're interested, definitely take a look at that. But let me go back to this idea of UI versus I like the lump sum scheme. I'm going to be focusing on these two just because they're the main ones. And so when you think about that, we will basically try to balance incentive with insurance in the way that I described just now. So the incentive component that we make it for instance fund job. On the insurance side, they're really trying to help workers against the types of risk. One is the risk of displacement itself, and also the risk of remaining unemployed for 5 years. And so July is displacement, and so it's worse for incentives because there is the income effect of receiving the benefits, but also the substitution effect of benefits being contingent on remaining unemployed. And particularly better for insurance because it's insuring against both types of risk. The long-term benefits, they are better for incentives because they're less extraordinary. There's only the tax, and the margin is only supporting the find jobs. But it's worse for insurance because it only insures against the risk of displacement. It doesn't differentiate between someone that is unemployed for a long time versus someone that is immediately reemployed. And what do we know about this? So on the incentive side, there is a lot of evidence on how different levels of benefits and different durations of benefits affect unemployment. So I'm putting to the one reference that kind of thinks about evidence from different countries, and we think that sort of fiscal externality framework that I'm taking about. For seven say there's less work, but there is one paper that is actually very influential that looks at how cash on hand workers at layoffs increase the duration of unemployment because people are liquidated. So this is actually a fact, job rate. But the reemployment effect of UI seems to be indeed larger than sort of providing the workers, which is consistent with what we would theoretically predict. And when we think about the insurance value, it's a much harder thing to test. So the risk is much smaller than the incentive side. But there are some very big effects on this because there's a lot more data actually available on the spending. There's data that is kind of like naturally occurring data from credit cards, bank accounts, and so on. And that allows us to actually track consumer spending changes when the workers are put by different types of costs. And so in the use of the consumption-based approach, the idea is that to approximate for that insurance value of that formula that I showed earlier, by basically looking at changes in consumer spending, multiplied by the conversion by some sort of and that was first proposed by Gruber, but since there's been like a lot of different papers that try to implement a consumer-based approach to insurance value of UI. you're gonna.
What is the interest rate or for on the benefit of like this line, but right, that's a
Mhm. Mhm.
so there's a separate like area that there's
Mhm.
right, like
Yeah, no,
like up to get on. So, and I guess for general, it's about like it you have to put that together, the not one or the other kind of that all that not be right benefit way, but kind of what that is the other thing. Right, anything like this, but about like what are the like
I think you can still use that framework, right? Because the way in which the design of the policy will affect both insurance side and right. So you're still trying to balance the side, of the trade-offs as you would do. So I think like you can use that idea. But I think like what I'm gonna get to in the next two slides is that actually this is it's a bit more complicated precisely because we know that the way that people spend these benefits is very specific to how they are actually dispersed. So I think like before we try and I think like it's very important to understand first like how exactly people spend the money in order to like really think carefully about the design. And I'm gonna in the very end, I'm gonna like discuss a little bit how different types of policies may affect the different and both the first effort the insurance value. But I think that that this framework is quite useful to think about all the other. Yeah, no, it's there are other reasons why we want there are many other financial problems that I'm not thinking about. The one that is the poverty of job types, the other labor market that is justified the type of poverty. There's also when you think about moral hazard, I'm really thinking about job search, but there's also moral hazard on the firm side, how and then the likelihood that it can happen. So I'm kind of not really getting into these other facts because here I want to focus more on the value. But if you're right that if there are other frictions in the labor market too, that will affect the value of of the so let me now talk about the consumption smoothing aids of government insurance because I think that's where I think we still don't know as much as the insurance side, and I think that's where the expensive side, and I think that's where we have like made some progress with them. One way to think about the need for insurance is to think about the consumption gap between when you are employed versus when you are unemployed. It's basically that can reduce the need for insurance. And in the case of Brazil, that I will explain in more detail in a little bit, we documented pretty clear and sharp drop in spending after job loss for workers that are not eligible to any job description insurance. In the U.S., the spending profile of workers show that also there is a clear drop when they are employed, but also a further drop when they are. So there is evidence of potential insurance value of these job displacement insurance benefits that is worth that are useful to think about. The other side of the trade-off. It's most of the literature is really thinking about incentives, but I think what I want to highlight here, given that this is about the economic. The compensation approach, when it was, when implemented either in Brazil or in the US or elsewhere, typically revealed that standard models of behavior they don't really do a very good job explaining the data. And that's where the UI literature meets the behavioral household finance literature. And in the behavioral household kind of research, it's quite been established for a long time that families have a high sensitivity to pets. So, you know, the paper by Terry Crawford actually shows the impact and the impact on consumption. And but it's not obvious that Ferrari work in the same way, given that people the concept of unemployed are subjected to the negative shock. So in the sense which people are very sensitive to this account will be actually quite important to think about this design, to think about those margins, you know, for the side of it referring to here. And so to get to that, I'm going to spend a little bit this paper that I have with Professor Haas that looks at job displacement insurance in Brazil and consumption. So in Brazil, workers, they receive both, they receive basically a lump sum of liquidity that comes from a 7K and a 7 access to 7 savings accounts at layoff. And they also have access to unemployment management. And the incentives to move in Brazil are particularly strong because, you know, this the positive lump sum transfer is transitory cost. And the layoff is actually negative permanent. There is evidence for that outside Brazil. But in the case of Brazil, it's the data, 75 of workers are still out of a job at month 5, which is the max UI duration. So it's actually even worse in the case of Brazil. And we studied the consumption profile of these workers and we do that by combining high frequency longitudinal data on spending and matched employer-employee records for about 400,000 workers. And the way that, you know, before I go into data, I just wanted to, you know, probably most of you are not familiar at all with the system, so I just want to quickly do an overview of what it looks like. So this is describing the job displacement insurance benefits for workers that are at least 1 year in the job once they are in the job. And so if they are 12 months in the job, they have access to unemployment insurance. So they must apply within 4 months of the job, and there is a third day period. And they can have 4 or 5 months of July, depending on tenure. So basically after 24 months, they have access to July. And the benefit level depends on the wage that they offer. For the average replacement rate is 175, it's actually relatively high. But it's mostly because a lot of workers are earning the minimum wage and that's the and then we have this that is a combination of, you know, the cyber savings account and cyber savings. So they can withdraw from this account called FCS, basically during employment of the employer deposits 8% of the monthly wage into an account that is liquid. And then workers can withdraw everything from this account related to that employment account that they are laid off from. Otherwise, you know, imbalance in the account, the workers. And then firms have to pay a fine to workers that is equal to 40% of the balance of the account. This is the severance pay bonus. And also one of ways. So in the sample, in our sample, workers are employed for 12 months. They get about 4 times the amount they wage. And workers for prior to pause, they don't get it. Okay. So it's just really that. So, um, so these accounts, they will have, it's possible, for example, again, well, they're things like, something that a worker was working in the market, they quit. If they quit, they don't have access. So that balance, they can get down. But then they get a much farther, get the doctor, other the severance pay and everything will be related to that contract. That previous contract was that they so it's all. Okay, so yeah, so and what and how do we measure income? So there is the anti-tax evasion program in São Paulo that was created in 2007 that I actually studied in another paper. And in that paper, I'm looking actually at the tax compliance effects of this program. And but the thing about that program is that it created monetary incentives for consumers to ask for receipts in their purchases. So the idea is that, you know, by creating this monetary incentives, people will be more likely to report the big ask for the receipts, that they can trail how the tax authority to ensure that firms are. And mechanically, the way in which they implement the policy is that, okay, we need to get these workers to ask. You know, it's something, we're going to give them some reward, but it's not going to be it's going to be a lot of money. So this has to be as low cost as possible for customers to participate. Otherwise, it's not going to work, right? So what they do is that they leverage the fact that receipts have a field to fill out the buyer tax number, because in transactions between firms, that's how firms can claim tax credit to those receipts, right? Because they have to collect the receipts and then pay the value added based on how much they sold versus how much tax credit they paid. And but for final consumer sales, this receipt would be basically blank, so filled with the blank. So what they did is that they said, okay, we'll allow firms and to put consumer ID numbers in that field, and then we will figure out lottery tickets and tax rebates based on the information that we gather with all of this stuff. So in a way, it was quite easy for consumers to participate because they can show up in a shop and say, you know, my ID number is 145, you know, and then the shop will fill that field and then remit that to the government, and the government will calculate all the and what that did effectively is that it created a database on the spending because it was linking specific receipts by the numbers. Okay. And then what consumers could also, you know, an online account and a tax authority website and see all the receipts that were issued with their ID numbers. And because it was so much easy for people to participate, because all they had to do is to say, you know, I want my receipt, my ID numbers, this one. There was a lot of clickups, but more than 8 million people had this online account at the website. And this created data expenditures. And in the way in which we can try and figure out, try to look at the data as consumption data is that we can classify what they're buying based on the characteristics of the seller. And this is very common with this literature. You know, often it's hard to use the detailed products that people are buying from. So we can kind of try to figure out what they're buying from the receipt, to try to figure out what they're buying based on where they're from. And so this receipt basically has the seller, and we know the sector of activity of the seller. And in the case of Brazil, the sector of activity is quite detailed. It's 7-digit number. So you can actually know if someone is buying something at a grocery, for example, or in a bakery. So we know whether that spending is safe for groceries versus pharmacy versus a party or and so on. And you know, and one thing that is important to keep in mind, and something that all this literature is actually quite careful about, is to kind of focus on non-durable things. That's why knowing, trying to classify what device is important, because consumption and transfer to different things, right? So, if you look at the total spending, indicate they're buying durable, and then that would really change the timing of consumption because, we consume durable for a period of time. And we're, especially if they're keeping high frequency, right? So it's because within a month, people buying, everything becomes durable. So we have to be quite careful with that. And often people look at food as a way to say it's really non-durable spending and for that as a way of getting actual. Yeah, so that's what I try to do. It's like say, okay, there is there are different reasons why this is we have to be careful about using the data. One is that because of the systematic differences in how people credibility. And there's also another issue which is that this is voluntary, right? But in general, like people make us not report change their propensity to report, depending even on the state of the world we're in, right? Like you can imagine that let's say someone that is unemployed, somebody that has a lot of time in their hands, and then maybe they're going to be asking for help, or if someone gets more money from somebody, they're going to be the opposite. They're going to be less because they already have a good money. So there could be ways in which the state of the world and the amount of money they have could also impact. So spends quite a bit of time in the paper trying to sort of validate the data. So we basically try to we look at other firms and we try to sort of basically what we need here is that there is kind of a constant coverage assumption. So if they say they're not very likely to report their receipts when they buy cigarettes or they buy food from because it's not very multiple item. The goal is that doesn't change once with the variations that we have, it shouldn't affect what we're looking at. And one thing that we did is to try and figure out whether this could be an issue is looking at, for example, the ranges transactions. So we basically did a survey of spend. And then we try to see whether the ratio expenditure of the versus the total spending by billings of wages, if that changes, if there is any kind of systematic relationship. And we don't find any systematic relationship in terms of higher wage people perhaps report less and receipts seems to be pretty constant across the distribution. And also another thing that is helpful is that let me just jump to this one real quick. Like if you look at, for example, fire workers that do not have access to any of these insurance, and they also have a lot of time in their hands, and they also, it could be the case that see change or it can be a very close relationship between how much money they have in hand and their position. So it seems like the patterns that we are looking at in this data seems to be driven by behavior regarding consumption rather than reporting impacts. Mm-hmm. like, provider, and that's precisely what you would expect. If the government gives back to consumers less than the actual tax they're getting from firms. You know, the big room for the buy. And that's why, you know, in the other paper about the enforcement effects that I referred to earlier, that's why, like, it's not an obvious example that that's going to have an impact on enforcement. But it does seem to have an impact on enforcement. And for a few reasons, I think, like, one is that, you know, it's this type of collusive deals are not that easy to do, especially if you have a lottery component attached to these receipts. So you have to kind of bargain over the exact, you know, amount that makes sense, given that it's not like, you know, they're not getting, say, 30% back exactly. They were getting a lottery tickets, they were getting some percentage of the tax paid. So there is that is one of the reasons why the is not that easy. And also we effectively see a lot of people asking for this. I think, like, the in terms of our specifically our users of the data, this type of concern wouldn't be a concern if it's not actually systematically changing with the variation that we are using to look at consumption change. So that then it goes back to this assumption of constant coverage that I was trying earlier. So as long as, like, these collusive deals, if they do exist, they don't vary with the we wouldn't be too worried about that. So yeah, so this is definitely partial data. But to some extent, you know, if they're not changing with the variation, then we wouldn't worry too much about it. One thing that is useful actually here is that even though it's possible that people wouldn't get the receipts for very small items, a lot of the data that it's used in this literature is based on credit card data. That maybe now it's more comprehensive because, you know, people use more their credit cards for everything today. But, you know, like at the time this was introduced in 2007, actually cash was still, you know, used quite a lot. And this data captures anything. It's not just about whether it's using a credit card, should any means of payment should be used. So all the data sets that are kind of naturally recurring, they have different trade-offs, you know. And I think, like, one way to think about it is like, okay, so how can I minimize, you know, concerns around the data quality, and what are reasonable assumptions that would make this data good enough for the purpose of the research question that you're trying to do, and then you try to substantiate to the extent that you can the assumptions that you're making. All right. So then, you know, just in a graph, just to explain, like, what I just explained that slide, but just over the south. Basically, there is a separate state, right, that is and then there is the statutory benefit. Basically, they have up to 5 months of UI. And then after that, they usually have nothing. And the accounts that they have, the separate savings accounts, it's basically illiquid as well. And here we're depicting, like, using real data, what the statutory benefits would be. And we are comparing the analysis sample, the benchmark sample, because also another thing that I didn't get into the details here is that we are using data specifically from workers that use an app to claim this benefit. So these might be positively selected, they might selected in many different ways. So throughout the paper, we try to sort of show the numbers for our analysis sample versus all the laid-off workers in the same time period. So this is the profile, and this is what I was saying earlier, is that, you know, in the case of Brazil, actually finding the job, the layoff is actually a pretty relevant shock. the hazard rates of finding a new job are pretty low throughout the unemployment scale. So here's the 0.06. And so that translates into a survival curve that, by month 5, which is when they exhaust UI, about 75% are still out of formal job. Here, our analysis sample is slightly positive selected as it's mentioned because it's the users of the app. But it's even them, they are very likely to be still out of a job when they exhaust all the benefits. In this shape, they comes from potential incentives from the UI system.
Why expired?
Yeah, the rates are here. The reason why things are much sharper is because people start claiming UI it's anytime between 0 and 4. And so for one of the analyses that we do, we try to sort of realign this to make sure that this is a bit sharper. And I'm going to show you that in a little bit. Mhm. So everything, so one thing that I didn't get into because it's not a development lecture is that this is all about formal, right? The job description is only about formal jobs. Because mechanically, the documents can only ensure things that they can actually observe, right? So this is all about. So there are many estimates about these things. I'm not I don't know off the top of my head in the case of Brazil, what is the share? But one thing to think, so one way in which this is important is that this is another way in which people can self-insure, right? Like they can just work informally. That's one way of supporting themselves. We do have some evidence from Mauritius actually that links survey data. There's another paper in the now that links survey data to London data. They do find like cleanly that people that are displaced from a formal job do work informally. However, it seems that these informal jobs, they have a pretty poor job in ensuring these workers. So, for example, this that I'm showing you, so these people could be working informally, right? And that might be one of the reasons why the consumption change is not bigger, but it's still kind of there for the government to intervene. And this is basically, the paper in a way. It's this graph in the sense that here we are looking at the consumption profile of workers around layoff at 0, and we actually observed that workers increase their consumption once they are laid off, and then so they increase basically around from month 0 to month 2, and then the consumption profile comes crashing down pretty sharply, and by the time that they hit the end of unemployment insurance, the exhaust benefits, they are already lower in terms of consumption than before layoff. And then it goes down even further. And then by month 12, they are about 17%, their consumption is about 17% lower than before layoff. And in a way, this is quite striking because if they had saved this lump sum, they would be able to sustain consumption at a pretty high level up until month 12. Yeah, so durables, they also increase a lot. So basically any consumption category shoots up when they so they all have the same sort of profile. The reason why we look at non-durables is for the reason that I was explaining earlier, that it's closer to consumption, but they do buy durables as well. Well, people, it's not just about quantity, right? People can also buy better things and they can send money, you can go to better restaurants, right? You can, so there are different markets increase, well, we don't have that information, yeah. No, we don't, yeah, because we don't know that, so the details of the receipt are not clean enough to actually know what they're buying, but yeah, that would be an interesting question, is like, is this about quantities or about, prices? I mean, so the way we are, the one thing that actually is related to this, that is, actually, it's not true that everything shoots up. One thing that doesn't increase, is food away from home. So a lot of people is, because they are not unemployed, like the way in which they consume changes, right? So the grocery shopping does go up. Uh, the way people do everything. So they are changing how they're trying to. So for our purpose, was like we're kind of bundling this because we don't know the details of what they're doing. We bundle together, saying food or non-durables and durables. Yeah. And yeah, and then the also I think that there are many reasons why this is important. Also, the coefficient risk aversion could be different across categories too, and yeah. And then the other thing that is important here that we document is that there is a lot of sensitivity to cash on hand if you look at other types of variation. So I just showed you, this spike in consumption and layoff. But if you look at within a month, so here basically we are computing their spending based on the time they receive unemployment benefits. Okay, and then because whenever they receive the benefit, there is an increase in consumer spending. Obviously, within a month, as I mentioned before, everything is durable to some extent. So this has to be interpreted with some caution. But one thing that's quite striking, and this is in the very last UI paycheck, the spike is as large as all the other ones, right? It's just as if like, this wasn't totally predictable, right? They know that they are going to exhaust their benefits at that point. And if you actually center the events around the exhaustion of UI benefits, the other one, we see this pretty sharp change in consumer spending when workers exhaust benefits. Mm-hmm. So the way in which we construct this graph is, so the black line there is looking at all so all the workers that hit the end of unemployment. But you included also like it didn't have the two curves. No, here is just a survival. But here we have both. That's the all adjustments, and the other ones are the ones that are based on the surviving sample. So typically, the surviving sample does worse than the average worker, and yeah. So and they are relevant for in different ways of thinking about this product, and I'm actually going to discuss that a little bit because the severance pay basically is targeting everyone, and the unemployment insurance targeting more the people that are employed for longer. But yeah, we look at different samples. I don't know if that's what you were. Yeah. Oh, I don't have this graph here, yeah. But one thing that we do in the paper is that we look at the consumption profile of workers that are reemployed at different points in time. And what's really striking is that it really doesn't matter. Like we look at like different events, basically depending on whether you're reemployed immediately or you're reemployed like 12 months later, and all of them have the same spike as layoff. The only difference is that the ones that are unemployed for longer, they have this much lower consumption later on because we didn't get reemployed. But yeah, so there are different ways in which we can. So one way that we can, as I'm going to explain a little bit, like one potential mechanism here that we believe the data is basically the people are present bias. I think like believe that there are other potential reasons why people may have a different spending profile than a regular voting agent. But the one mechanism that can actually account for all these different patterns seems to be something related to present bias. So I'm going to get to this. And one thing that is, and just like, it's how happen exactly. I just wanted to quickly explain what we do is actually we are looking at workers that are continuously, basically we're doing a different dip at each point, right? So we have a control group that is continuously employed. We randomly assign a layoff date for the control group that is employed. And compare them to the laid off workers. Okay. So let me move on. So we find this exhaustion, the effect on UI exhaustion that is quite remarkable because here is really something that's perfectly predictable, right? They know exactly how many months they have UI for. And what is really interesting is that this is exactly what happens in the United States as well. So these are very different contexts, right? Like Ricardo was saying, like there's a lot of informal work in Brazil, like completely different setup. And this is the US, it's from Chevron and Well, and they use data from US banking to track consumer spending. And they know when the UI check arrives, they track what happens to the consumption profile once that hits the workers. And also they have policy variations in the US, UI, the amount, the generosity of UI depends on. And what they find is exactly what we documented, which is that, by the time that the UI is done, there's this very sharp drop in and really exactly as the month was done. So it varies, Florida is earlier, and in other states that have 6 months rise later. And so how to explain this, which is I guess the fact that earlier. So the usual standard model job search and function with the constraints that it's like why different with part of agents. These these cannot account for these two key facts, which is a high propensity to consume out of liquidity and a very low propensity to save in anticipation of an aggregation. And what we find in our paper is that by just adding present bias to the usual job search model can actually go a long way in explaining these two facts. And in particular,
The model also makes different predicted percentage on durable versus non-durable. Like there is a stat on, like the effective patient is the best law on or durable because of the that goes away. And then I think I heard you say that you actually find the same kind of for durable versus non-durable.
well, I mean, the thing about durables though is that, especially in the context of that, people may have very strong forms ways that are probably worse than So having a lump sum allows you to make lumpy purchase. So even if you have a completely rational model, you can imagine that by receiving a lump sum, you would increase spending on durables because you have all these things. So I think you need in order to also explain the low propensity state, nation of a shop, you need something else. But it's part because the fight for durables could come from the from like other means that you could or like I mean that's no, sorry, actually I don't know that. Yeah, so let's just try that. I know that so throughout the paper we really looked at durables. For the spike at layoff, we observed we looked at across all categories. We did not replicate the design of exhaustion for durables. Right, I still don't know.
Yeah, there is a comparable strategy order.
Yeah, but actually, I don't know if we could have that effect with durables. We definitely have the size, but Mhm. 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 Yeah, so actually, thinking of just discussing a bit the research process, once we found this effect, we were asking exactly this question. So we actually this is not in the paper, we actually run some focus groups that we're trying to understand, like with unemployed workers, to try and understand like how they think about the different consumption profiles. And it's funny because actually we show the graph that's, and how the kind of the average worker was like 70% and then 70% lower consumption before. And a lot of the reactions like, oh, I think they did a great job. I actually, for me, it was much worse. So like you hear people having real, difficulty managing the amount of resources. Especially for a lot of them was kind of they never had that much money before in their hands. Speaking about the lump sum, but I think also there is the reason why we actually focus on the sophisticated developers also from running surveys. So we did this focus groups, and then we did a survey with workers that were applying to UI, and we find that 50% of them say that they would not prefer to get UI lump sum. We asked them like, would you prefer to get all the UI now instead of having it installment? And then all of them said no, because they want to prefer expenditures or not spend all at once. They seem to be very aware of their profile. And actually, my phone for now is more skills here that where they're trying to actually elicit like how much people want to have this kind of right. And 50% of them seem to prefer monthly payments over lump sum of benefits to help towards the typical response that we get. And in the context of development, there are also potential other explanations that have nothing to do with the behavioral stories that are relevant to patients' strength. So one thing that has been come up with is speech affecting other pressures, for example, money, or saving technology can smooth through savings, then you should observe a pattern exactly like what we just described. But that's not really relevant for the context that we are looking at in Brazil, but this could be relevant for other contexts. A lot of heterogeneity, actually. across like we looked at different types of characteristics of workers, and we actually didn't find much difference at all. It seems similarly, to that heterogeneity about when people get reemployed, also we didn't find much different either. So it seems like a pretty consistent pattern across like all different ways in which and if you think about actually a model, so like we try to fit a model into the key moments of the data. So here we are actually the targeted moments, we are actually lining them up in a way that things are a bit more precise. So here everyone is taking up to Y at month one, because the exhaustion effect more clearly. And basically to look at the usual forward-looking model, you should observe a pattern. So quite smooth, right? Which is definitely not the case. And if you look at a sophisticated beta delta model, it seems like we were able to both predict the spike at layoff and this low propensity to save when they got benefit with reasonable parameter values. So like around the beta is around 0.7. And it seems that we could try other models. So for example, we could look at, we could just forget about that delta, just look at allow the delta to be anything. What we find is that actually fits really well the data with a really unreasonable delta. You would require a high degree of myopia to explain this. And so because of the experimental design, like we can't really pin down exactly which model is the correct one, but what we can do is to say, okay, like which one is most consistent with the data within reasonable parameters. Yeah, so I mean, in the model, we allow workers to because it's Brazil, like we allow workers to generate some sort of other source of income. So there's a costly source of income that is generated by, for example, working formally. And that's how we get we don't get consumption to go to a very low level. And then I would actually have a more heterogeneity, create more heterogeneity in the types of workers. And in our case, we do this, we have this additional source of income that can be generated from the work. Right. Yeah, they are because they run completely out of benefits. Yeah. So they have actually there is spousal income, and then there is this costly form of income that can generate through. So how much time? 10 minutes. Okay, outside there. Okay. So and also another thing that we did is we looked at the naive beta delta. And it also generates kind of roughly the spike in the low frequency phase. But it requires a lot more intake. The message is much lower. And we don't think that that's the best model, not only because we have this depth of evidence with the recent for placement from the data, but also because it seems the sophisticated seems to better fit the data, and in part because the reason why we think that's we can generate a good fit for the empirical moment with a beta that is not too low. It's because workers basically they are aware of their self control problem. And without a commitment device, they know that they would spend their money very quickly. So they tend to kind of try to smooth out will be a bit different. And so that's one of the reasons why we can actually get a beta that is not too low with the sophisticated one. And what are the implications here for policy design? That's what I wanted to explore in the last bit. So the difference between severance pay and UI, I usually focus on this contingency policy, as I was saying earlier. UI tends to target better workers that are employed for longer, but they also generate more efficiency costs. And you can think about a very simple exercise where, let's say, you transfer $1 from severance pay to those that are maxing UI, they're agreeing to pay the duration of UI it's time T. And you think that, like, the share of workers remaining without a job at the additional UI will affect basically a share as of the population, like everyone that reached the end of UI register. Each of them will receive 1 over the amount that is distributed here. So basically what we do is just comparing the benefits, the margin utility from, this benefit when you're from Y versus the utility, the margin utility from when you actually get the severance pay. And so the one way to kind of understand how this behavioral biases affect this margin utility is that the workers who remain. So if you think about the sort of a standard framework, you'll get an insurance gain if those margin utilities of when workers reach the end of employment benefits is larger than the average margin utility of who's receiving severance pay of the employee itself. And basically that tells us the difference between the survival group versus the average worker that is being employed. And typically the survival group is needs more support than the jobs quicker. And if most workers find jobs quickly, then UI will be better targeted than a severance pay because they are the ones that if most workers take a long time to find jobs, the targeting difference will matter a lot, right? So it's about labor market. It's very hard to find jobs. The targeting benefits is a little bit less relevant. But one thing that, so this is, the usual way to think about it, but the another key feature is that there is a difference in disbursement policy. So, the severance pay disbursed on some and UI is the same thing. And even standard framework, the disbursement shouldn't matter much because one can always be the same. And the things can always be saved to some extent. So you can use those moments. But there is clear evidence of and so there is an additional insurance advantage of UI relatively separate state that comes from the fact that you are transferring resources to a state of the world that people actually have even higher margins of consumption than we would think. We didn't consider the market they're getting is actually much smaller than when you're looking at unemployment benefits. And then one way we try to think about contextual policy is what would be the gain from having say UI ultimately severance pay only or severance pay that is disbursed installment. So they were trying to, so this is an untested policy. I don't know if it comes to that does that. But we're trying to sort of have a sense of like how much is from allowing. In the way we so it's like basically use the data the self model, and we make the cost of the policy saying that these different policies. And so the way we do that, so basically depending on the applies to the profile and also the type of business. So, in the case of the of low benefit, to the level of students who drop some sensitive their market. Um, and so if only the lump sum, so we could increase exactly as enough, but then nothing basically uh, very little, uh, uh, when if you have only Y, you think longer, but then it comes also drops at the often the 5 months. But then if you have a lump sum that reverts slowly, we follow the tree, yeah, the dark triangle. What if there is a, it's, you're forcing them to basically move consumption, so you do have better insurance value. But it's slightly, it's lower than what you have if you buy just because of this targeting issue that I was saying earlier. Here you're transferring money just for the only for the ones that are still unemployed, and for the policy of the installment, you're transferring money for everybody, right? So it's, that's why you end up having a smaller on average it's a work target. And you see that there are clear welfare benefits from this 5-month installment. And when you can do that without necessarily generating the same incentive problem. So if you look at the hazard rate, the one, the unemployment one with UI really has that case data that is earlier. And you can basically generate a very similar employment rate with this sort of installment, like executing installment without taking the incentive effect, but there could still be some for that because it wouldn't be as started as why. Okay. So basically the idea here is that policies that target the high marginal propensity, the high marginal utility state of the world more effectively will lead to higher welfare gains. That's not necessarily too deep. But the key thing is that this excess in depression will affect which states it should be targeted. And what that implies is that the insurance value of one schemes becomes more limited, not only because of this targeting issue, but also because of across workers, but also because you're spending money when margin is already priced low. And that does not mean that all transfers to be avoided. There are other reasons why they want to have transfers. So, for example, we could have actually difficult to sort of building up space for investment. Maybe that's one way of, that's to deal with sort of thing. But if the goal is to provide help consumers, workers smooth consumption, then it might not be the best way.
A lot of this this also suggests, that further like there are high so liquidity. The thing like here liquidity because it's very thick. But those kind of percentage. I don't know what I think. They have that but
So I mean, we didn't pay much attention, like everybody does, have the first ICT. But it's true that low income foreign people, they might have other needs, right? Then maybe they want to actually invest on an asset. And so giving access to liquidity to them might be actually particularly helpful. So in that sense, yeah, I think like there are different reasons why you may want to design these policies in a way that addresses the different needs. I think the only thing that is important to consider is that if the idea is to help customers smooth, then it's not a great idea, but it might be addressing other needs, and that's what we're trying to say. And also policies that help workers save could potentially improve welfare in this kind of context model, but then dispersing them lump sum makes little sense. If the whole policy goal is to help them yield savings because they're not doing that otherwise, we say the buyers who may want to disperse it slowly as well, exactly because they have a present bias problem. And another thing that is important that the detail in the NOL is that the duration becomes particularly relevant, precisely because the duration extensions will better target the states of the world where benefits have a particularly high return because of the spend they're and actually calculate from extending to vibration benefits as large as raising benefit levels because of these improvements in targeting. And what are the kind of the broader lessons here? So I think this one thing that is interesting is that this behavioral consumption patterns differ stable across very different contexts. And in the case of Brazil, actually, the exhaustion effect is particularly striking because in the US, people have very little liquidity. It's very, in many countries, workers are laid off, they have very little liquidity. In the case of Brazil, they have actually a lot of liquidity because they could have pulled out the exhaustion of UI benefits, and that's not what we observed. There's a thing between parallel to the one of our communities. Things that have been found both in Mexico and the UK. Which is kind of reassuring that because I think the learning something that is a bit more fundamental about decision making, that the relative institution vary because these are very different contexts and still you find similar behavioral patterns. And there is still a lot of many gaps in the literature. Just that's one of the first graphs that I showed. We don't know very little about teleconsumption in general. Certain policies beyond UI and outside of countries, I think it's very important. And opportunities will be improved here because we have a lot of countries that include data collection. So and also understanding how other restrictions may affect drug displacement insurance here. And a lot of the literature is focused on present bias because the most practically find, right? Like if you look at the data, it's possible to deny that there is something behavior impact. But there are other things that are important too, right? And you don't necessarily know there's for drug displacement insurance policy fraud. There's a lot more for UI, but less for. So yeah, so I'm going to end here. Thank you very much.